We're Compound Everything, and we talk about money, markets, and investments. And this week we are discussing whether or not your primary dwelling is an investment.
Yeah. So how did we come on this topic?
So I think a few years ago, I want to say 4 years ago now, we were at your brother's place, and your father was there, and we were talking about our houses, and we were discussing what we bought them for.
Yep. And how much they appreciated, and how much we figure we could sell them for now, et cetera, et cetera.
Right. And then I said, oh, wow, that's like a pretty decent investment. I said that to your dad. And your brother was very quick to say, well, you have to take out all the maintenance capex, the growth capex, I guess you could call it, for renovations and whatnot. You've got to take out property tax, house insurance, all of that.
Yep.
And I was like, oh, you're right. You can't just take the buy price and the sell price and say, oh, that's my return.
Yeah, and that's the temptation, isn't it? So, I mean, that's often what we were doing before we reflected on how much our house is appreciated and, you know, what the return would be on our house, et cetera, et cetera.
Right.
Yeah.
And so I came home that night.
Yeah, you were very fired up about that.
I was.
Not in a bad way, but interested way.
I was so interested to know, like, what is the return on our house? And I punched in on the numbers. I didn't even take out the property tax at that time.
No.
The only thing I took out was capital expenditures.
Yeah.
So renovations we had done, things like replacing furnaces, stuff like that. And we actually had about a 1.2% annualized return on our home after you took that out.
Not so hot.
Yeah.
You beat that in a checking account.
Yeah. And it was always weird to me when people would say, oh, your house is an investment, or, you know, a big part of my retirement is in the equity of my home. Because I thought, well, in order to unlock that, you would have to be homeless.
Yeah. Well, it's a bit of a double-edged sword, right? So with that equity you have in the house, you always have to look at investments in terms of what is the cash flow that the investment is going to give me. And you have to look at it in terms of alternatives, right? So if you're living in a house, there's no cash flow. But on the other hand, that's a bit of a quagmire because you need somewhere to live.
Right,
if you're not owning the house, you're renting somewhere.
Right, exactly. Yeah. You're not homeless.
You're not homeless.
Generally.
There's not too many people investing in the S&P 500 who are homeless.
Right.
Maybe that's a hack. I don't know.
So at this time, I was actually pretty green with investing. I was actually investing some money in the market. So I understood valuing a stock. I understood finding an undervalued company or a great company at a fair price or whatever you want to call it. But I wasn't so great at the idea, or it hadn't really come into my mind yet, that you should be looking at every investment against other investments. Right.
And so that's what we're going to do a little bit today. We're going to break down some houses as real life examples, or as close as we can get to real life examples. Now, keep in mind, this is in one area of Canada, so it doesn't represent everywhere. So there's going to be outliers here and there. But I mean, I think there's very little question that housing has appreciated over time.
In Canada especially.
Well, just in general. I think like anywhere in pretty much North America, you hear like our grandparents. Like our grandparents bought houses and cabins for like 4 digits.
Yeah.
Right? Like that's insane.
Yeah,
like,
I think
no one's selling property anymore for 4 digits.
Yeah, I think your grandfather bought his cabin for $2,000 over a bottle of beer.
Those kind of things.
So goes the story.
I mean, I heard of someone who actually won a cabin in a poker game. Now, maybe that's not a great. Maybe that's not a great way to acquire or to lose a cabin or to lose property.
Yeah.
And maybe that still happens. I don't know.
Right.
But anyway, the point being is, the housing has appreciated. There's no question. And even our own house, if we look at what we purchased our house for 19 years ago, it's appreciated substantially. It's more than doubled.
Yeah.
Right. So, and we'll break that down in a moment.
Yeah.
So I think there's very little question that housing has appreciated. But the question is, if you compare that to alternatives, what is your yield?
And your time. How long? You said our house has over doubled. That's true, but we've lived here for 19 years.
That's correct.
So it's not as great as it sounds.
Right. We'll break that down.
Right. Okay. So how should we go? Who should go first? So you did our house.
Yeah.
And then I did a house of my grandfather.
Sure.
And because we did a few generations. And then I did friends who are kind of around our parents' age.
Okay.
Yeah.
So let me just predicate that by saying, overall, I found an article recently, I think it was 2018 that the article was written, and maybe it's a little bit out of date, but they had said in taking 16 countries on average, in 16 countries, housing and real estate had appreciated by 7% per annum.
Okay.
But in our own little niche of, Canada, we've found that not to be true.
No, we found it to be more 5%.
More 5%. And actually, it's almost across the board from all the examples that we could think of where we had reasonably reliable numbers. We had your grandparents, we had some friends of ours who were a little older, and we had our own house.
Yes.
Yeah.
Yeah, and we found that, and it was 5%. That was pre any maintenance.
Yes, that's
that was
right.
just if you were able to buy the house and sell it.
No
not doing
capex.
it right.
Yeah, no capex,
No
no
property tax.
property tax, no insurance.
Very unrealistic.
Very unrealistic because these are all real costs.
Yeah.
So 5% CAGR
Yeah.
for housing prices. So why don't you go first? We'll kind of do it generationally.
Yeah.
So why don't we do, because you have some pretty reliable numbers about your grandparents.
I hope so, yeah.
Yeah. So go ahead.
Okay, so I'm going to use my notes because I'm going to get the numbers wrong if
Sure.
I don't. So my grandfather bought his house sometime in the mid 1950s. I don't know the exact date, and he's passed away, so I can't ask him, but I know that they had 2 kids when they moved.
Yep.
So given their age, I assume it's around 1955
Okay.
that they moved into their house. So they bought their house for $10,000.
Okay.
I did a little bit of digging as much as I could. It's actually hard to find some information because I had to go back and find what one thing I didn't do is look into interest rates. So I just assumed whatever the interest rate is today, that's what I assumed for them.
Okay.
And I figured that was safe because interest rates are always changing anyways. And if you own a house for a long time,
I mean, I think a reasonable average would be what you would be getting about now, so 5 or 6%.
Yeah, interesting, because I actually was talking to your mom yesterday, and she was saying, I'm seeing so many people complain about these high interest rates, but she's like, I feel like we're just about average right now, because they've lived through many different eras
there's up
of
and down
interest
cycles,
rates.
for sure.
Okay, so back to my grandfather.
Okay.
So he bought his house for $10,000. We're going to assume that at that time, the regulations were the same, and you had to put 20% down on a house.
Sure.
I actually don't know that. I can't ask him.
No.
But we're going to assume that at that time, you had to put 20% down just like you do today.
Sure.
So he bought for $10,000. He put down $2,000. That leaves him with a mortgage of $8,000.
Okay.
I figured he amortized that over 10 years because it seems to me, the more I look into it and the more I talk to people, the amortization of a home has gotten longer with each generation.
I would say that's true. And we've seen that actually even in our own lifetime.
Yes, even in our own lifetime. So he would be paying about $70 a month, I figure, at a 5% interest rate. Okay? So he bought it for $10,000. He paid off $2,000. He's paying $70 a month. At $8,000 over 10 years, that's $800 a year, but you have to account for the interest.
Yep.
Right? So that's about $840 a year. And so that means he was paying a mortgage of $70 a month.
Okay.
Now you're like, why does that matter? Well, it matters because you need to live somewhere.
Yep. Oh, absolutely.
So I figured, let's say, for fun, my grandfather didn't buy this house.
Sure.
Because that's the whole point of this. He didn't buy this house. He decided just to rent. He never bought this house. He decided he was going to rent. And then so I had to go back and think, okay, well, how much were rents in our area? That's hard to find because it's very, you have to...
Because you want comparables.
Because you want comparables. In the 1950s.
Sure.
And I finally came across something that said the rent was between $40 and $50 a month at that time to rent a home. Okay? So I said if he was renting, he would be renting about for $40, $50 a month, a little less than the mortgage, but he wouldn't have that equity.
Right.
So then the question is, was it worth it for him to give up the equity in the home?
In the home, right, exactly.
So I said that he lived in his house for 50 years. I think that is about right.
Okay.
I actually think it was longer than 50 years, but 50 is a nice...
It's a round number.
It's a round number. So if he took that money of $2,000, just the down payment, on his house, and he put that into the SPY, and then every month he added $50 to it because he's not paying his mortgage. He is paying his rent, but we're going to assume he's savvy with money because he's decided that I'm not buying a home. I'm going to put my money into the SPY. So he's now putting $50 a month every year into the SPY over those 50 years that he lived in his home. If he did that, he would have $591,973.
Wow.
This is all in today's dollars. Yeah. So when his house sold, I looked back at when his house sold, and the average house in his area sold between $280,000 and $300,000.
Oh, wow.
Now, I would say, and I think you would agree, that his house was probably considered one of the nicer houses in the area. So he sold it for $320,000. The SPY he would have had $591,000.
Oh, wow.
But this is not including any capex.
Right.
Yeah. So he puts $10,000. He buys this asset for $10,000, right? He's paying interest on it. He's paying capex, but not even including that, he still doesn't come out ahead.
Right. He would have been better off investing in the SPY.
Yes, and this was someone who bought their house in the 1950s.
Sure.
So in the 1950s, it was more advantageous for him to take that down payment and then to put a payment every month. Right, for the same amount of time that he lived in the house, and he comes out way ahead.
Interesting.
Yeah, which makes sense.
Yeah.
Because we said that we found that properties tend to go up over time at about 5%.
Give or take.
Not including.
Not including any expenditures.
Right. And we know the SPY goes up on average over the long term, somewhere between like 8 and 10%.
8 and 10%, somewhere, depending dividend reinvestment or if that's accounted for or not.
Right, and all of that.
Yeah.
Okay, so that's my grandfather.
Okay.
So now we'll move on to our friends who are like mid-60s, and we were just talking to them. So they bought their house in 1986 for $108,000.
Okay.
We assume today it would sell for $500,000.
Yep.
Given comparables in the area. And this was a little bit more of an interesting case study because to circle back to my grandfather, when his house sold, the area was still relatively the same type of area. So he bought his house, having talked to him when he was alive, he said, oh, there was no other houses on the street.
Right.
We were one of the only ones.
Wow.
And then by the time he sold, that area was considered a middle class area.
Sure.
This is a little bit of a different case study because this area was very much a middle class area and it slowly kind of declined into a little less than working class area.
That's right.
I would say.
Yeah.
So in 1986, to say again, they bought the house for $108,000. Today, according to comparables, we'd say they would sell for $500,000.
Yep. Okay.
Their mortgage payments would be about $541, and rents at that time were around $400.
Okay.
So
for a comparable home.
For a comparable home. So if they had to put the 20% down, you're looking at about $21,000. But if they took that $21,000 and put it in the SPY, if they lived in the house for 37 years. So today, like right now, would mark that they had lived there for 37 years because we're saying they would sell the house today at market value because we can't project where the house is going to be in the future.
No.
My grandfather was different because he actually, that happened.
Yep.
So we're saying you sold their house today.
Yep.
That would make 37 years. If you put that $21,000 in the SPY and you put $100 a month in, never raising it, which we know obviously you would have raised that over time, but you never raised it, you would end up with $742,000.
Wow.
Yeah, but you could sell it presumably for $500,000,
right?
Not including what you lose,
right,
to the real estate agent.
To the real estate agent, yeah,
right. So they sell their house for $500,000. They bought it for $108,000. That's about a $400,000 difference, right? Make the numbers easy.
A gain of $400,000.
Yeah, a gain of $400,000. Except that we didn't take out any CapEx.
We didn't take out any CapEx. These friends have done a lot of renovations on their home. Extensive renovations.
Yeah. And over and over and over again.
Yeah.
And we figure how much in dollar value.
Oh, have they put in?
So yesterday I ran the numbers. I was running through all the things that they've done.
Okay,
and I figure it's about $200,000.
I would think that's about right.
And I'm thinking that's low.
Yeah, it's possible.
I
would say that's a conservative estimate.
Yeah, and that doesn't include property tax.
Property tax, insurance, all these other things over the past 38 years.
Right, so we're going to say they bought their house for $108,000, we'll just say $100,000, and they put $200,000 in, that's $300,000 now that this house has cost them.
Yeah.
They can sell it for $500,000. Now that's only a difference of $200,000.
Right.
Meanwhile, all that money in the SPY
has compounded.
There's no maintenance CapEx.
Zero.
Right.
Yeah. I mean, the only thing you'll get is a commission, maybe.
Right.
And even then now, there's commission free.
Yeah, exactly. So that was very interesting because that's two different generations.
Yeah.
Because I was thinking in my head when we were talking about our house, and I was like, well, maybe we're just in a bad generation because maybe the housing market had exploded so much, right? But maybe had we bought in the 80s, like our friends, or in the 50s, like my grandparents, maybe it would have been better because they just caught those boom, like the real estate has just gone up. But it's really hasn't been better than the SPY over any time.
Any time we examined. And we'll do our house shortly. I think one of the things that to think about that I guess someone may contend, well, what about taxes and whatnot? So in Canada, which we talked about. So some might contend and say, well, what about taxes? When you own a primary dwelling, you're not paying taxes necessarily. You're not paying capital gains until you sell the asset.
And even then, you don't pay capital gains if it's your primary residence.
That's right. So in Canada, and I'm not sure how it is in America, I don't know the tax laws there, but in Canada, if you're on your primary residence, there is no tax when you sell your primary dwelling.
But there would be if you cashed out of the SPY.
Except now that there's tax-free vehicles with which to invest. Okay. So you can either use your RSPs or you can use your TFSAs, which I think is even better, the TFSA. So you can easily throw money into the TFSA. If you're our age, you have a fair amount of room in the TFSA that you can contribute, and you contribute up to $6,000 a year per person. So
and then
for
it's
us,
more of an apples to apples comparison.
Now it's more of an apples to apples comparison because taxes are avoided in that scenario. So, I mean, from that standpoint, what used to be a cogent argument is no longer. Right. And so the funny thing is actually some of the politicians now have started discussing whether they should be taxing the sale of a primary dwelling, which would make that investment even less attractive.
Right.
Funny enough.
Well, the government likes to make investments less attractive. They don't like their population making money.
Yes.
Yeah.
I mean, that's a bit of an aside, and I don't want to get into politics or anything like that, but it becomes an interesting prospect when you start to examine comparables. So having a home as an investment, if they're going to be taxing primary dwellings as opposed to shunting money in a TFSA, becomes much less of a interesting proposal.
And I'm going to keep saying it. If your primary home is a vehicle that you use to build equity, how do you unlock it?
Yes.
How do you unlock it having lived there?
Right.
You need a place to live.
That's right.
And I heard a guy recently a guy I follow on social media, and I had never thought of this, but this was such a good point, and our son actually said it a few days later without even knowing that I had watched it, is that like if you live so we live in a working class area. After we did all this, I was curious as to what type of area that we lived in. And so I Googled like in this city, in this province, in this area. I got real niche what type of area would it be considered. And apparently it is a working class area.
There we go.
So we live in a working class area. So if we unlocked our house and we sold it and we moved, we can only still afford a working class area house.
That's right.
We can't take this money now and not add to it to move up to a middle class.
Right.
And if we lived in a middle class, we can't move to an upper middle class without taking out more of a mortgage.
Right. Or putting in more money.
Right. Your house is it's just always going to be a lateral move. A working class house is always going to be worth
a working class house.
So if, let's say, we go through a huge real estate boom again, and all of a sudden the house that we're living in is $1 million.
Yes.
Well, that just means that a working class house is $1 million. It
That's
doesn't mean that you're any more ahead.
No, not really. And the funny thing is, go back to what we said about our friend's example, about the neighborhood decline.
Yeah, they really got handed a rough deal, I think.
Yeah, so I mean, when you purchase a home, you may be purchasing it what is at that time a nice neighborhood. But unfortunately, just like anything, and some people say, well, investing in the market is somewhat unpredictable. But I would contend and say that sometimes real estate can be unpredictable as well, because the neighborhood can decline.
Oh, so that's out of your control.
And that's outside of your control as well. So for our friend's example, if you take their house and the property they have and you moved it to another area, you could easily add another $250,000 to the value of that home, just putting it in another area.
Yeah.
That exact same home in another area would easily be worth more. But because of the area it's in, that limits the upside.
Right, because anyone looking to spend that much on a house isn't wanting to live in their area.
Exactly. Yeah. And so you can see things like that. And so I think at the end of the day, housing is still got some things in there that are not in your control necessarily.
I will say too that I think their annualized return was like 1.38%.
Yeah.
Which over that time. So it's interesting because I was like, did they overpay for their house? Was it just that their renovations were so expensive? Like they had the worst return on their home. And I'm just wondering if it's because in part the house was beautiful.
Yeah.
Is beautiful.
It is beautiful.
And at that time, that was a very great neighborhood. And so they probably paid a premium for their house because it was in a great neighborhood.
Yeah.
And now that premium is gone.
That's a very good point.
Now you're paying a discount because the neighborhood has just really drastically changed.
Yeah. Well, maybe that's a hack. If you want a really nice house and you don't want to pay up for it, you can find the nicest house in a neighborhood that's declined somewhat.
Right, you'll get a discount.
And you'll get a discount on the home.
Yeah, exactly.
Right? So I think, and at the end of the day, we don't want to necessarily knock home ownership per se.
No.
But what we are saying is we're calling into question whether home ownership is actually an investment or not.
And if you are an investor and you want to grow your money in the best way, then it's something to think about. At the same time, I know that the house we're sitting in right now is an endless money pit.
Oh, yeah.
I know that we will never see a great return on it.
Yeah.
I know that. But I like that we're not going to be uprooted. I like that our landlord's not going to be like, oh, I'm selling the house in a few months. You're going to have to find a new place
to live.
I like that it's ours. I like that I can paint the walls whatever color I want to. I just enjoy that. I like that. I know my neighbors are pretty permanent and we like our neighbors.
That's right.
And so the utility of owning a home for me is worth the fact that it's not a great investment.
That's right. But I think we have to start reframing, is a home an investment or is it more so just an asset per se?
Right.
Or oftentimes maybe it's a liability.
I was going to say,
Right?
I think our house is a liability.
Well, I came across a quote actually by the author of I'll Teach You to Be Rich. It says something to the effect of, rent is the maximum amount you're going to pay. A mortgage is the minimum.
Right.
And I think that's very good advice.
Yes.
And I think that's a good segue to go to our
I was
house.
just going to say, that's the perfect segue for you to go to our
Okay.
house. So you did quite an extensive
Breakdown of our
breakdown into our house, much more extensive than what I did. And a good reason of that is because we knew the actual numbers. We had
Yes.
to do a lot of assumptions with the other ones.
Yeah. So I used what are pretty hard numbers for our house. I mean, I guessed on some of them because I didn't feel like going back and pulling up 19 years of property taxes. So full disclosure, as you mentioned, we bought our house in 2005. And so we bought it. The purchase price was $200,000. And so for $200,000, we purchased the home. There's mortgages and stuff like that involved, and I won't get into the details of that. But I'll run a 19 years worth of mortgage and compare that to rent and things like that. So we bought it for $200,000 19 years ago, and we figure right now we could probably sell it for about $500,000, give or take. Okay. Now, in that time frame, we've also done renovations on the house. Some were needed, some were not. Okay. And I think we've enjoyed them all. Well, no, we haven't. That's not true. We've enjoyed the optional ones, but some of them were necessary. For instance, we put a new roof on the house because the roof started leaking. That was large. We added an addition. That was more fun. We added a pool. We added a deck. We added things just to make the house more enjoyable. And I'm not sure we've encompassed all of them, but we figure roughly we've spent about $160,000 in renovations on our home.
Because to me, I've never looked at our house as an investment. It's just a place that we live.
That's
I
right.
want our kids to be comfortable here.
Yep.
I want company to come over and feel comfortable.
Well, we want to be comfortable here.
And we want to be comfortable here.
So, and it actually needs more work if you really think about it.
And that's the interesting thing, just to digress a little bit. If you rented a house, you would probably be less attached to your home.
Yes.
And so it wouldn't bother you the same. I'm convinced that on a psychological level, if you rented a home, all the things that go wrong wouldn't bother you the same way if it wasn't yours.
Yeah. I mean, just 2 years ago, we've replaced our furnace for the second time. A few years before that, we replaced our air conditioner because it went.
We just replaced our oven.
We just replaced our oven. And these are all things that we're looking at replacing our fridge. You
and I aren't like quick replacers.
No.
Like we only replace these things if they are 100%, and I don't even mean like they're broken. Like right now, the fridge, like that piece is coming off. The suction piece, we've like safety glued it back together. So we're not super quick. Like we're not spending a lot. We're trying to do as little capex as possible.
Yes, that's right. Because we'd rather invest that money and watch it grow.
Exactly.
Right. We replaced many of our windows because they were old and they were leaking, and so all these things come into play. Whereas if you were renting a home, you wouldn't have.
You would hold loosely.
You would hold loosely, and if you didn't like it, you go find somewhere else that's nicer, where the landlord is upkeeping it.
And I don't even think if you didn't like it, it wouldn't bother you because you're like, meh, it's not mine.
That's right. Yeah. So let's go through some hard numbers. So we've given you the purchase price, and we give you what we figure we could sell it for right now. And so we figured over the past 19 years, so the most recent property tax bill I think we're going to get is about $5,000.
This year, yeah.
Give or take. I didn't put the exact numbers in, but $5,000 is about right. And so I discounted that by about 3% to the time we bought the house. Because again, I got lazy. I didn't want to pull up 19 years of property tax records and put the exact numbers in.
I do have them, but...
Yes, I didn't feel like putting in all those numbers. Yeah. So I discounted those by 3% because that's typically what our property tax has gone up. Yeah. Except for this most recent year, it's gone up much more.
It's proposed to go up 9%.
That's right. So that's a bit of an outlier.
Yeah.
But over the past 19 years, we'll have paid $73,231.21 in property tax as an estimate. So about $73,000 in property tax in the 19 years we've owned the house. So that needs to be deducted from that $500,000 sale price, 100%. Right?
100%.
Now, home insurance. Home insurance is kind of important. Yeah. You don't want your house to burn down. If your house burns down,
you want someone to rebuild it.
You want someone to rebuild it for you.
Yeah.
So for house insurance, our most recent house insurance would be about $1,500, and I discounted that back. And that would be, over the 19 years, we've paid $21,969 in house insurance.
Right, so now we've got to take that out of
So now we have to take that out. So that equates to about $95,000 of costs that we have to take out of our purchase price.
That must have been paid. We had to pay house insurance, and we had to pay property tax.
Now these would be things that you would not have to pay if you rented, right? So the house insurance would be the landlord's problem.
Right. You would get content insurance, but content insurance is much less than
It's much cheaper than that.
Home insurance.
Yeah. And you wouldn't be paying property tax, obviously, if you're a tenant. So now if we also go through a mortgage. So I assumed that we put 20% down. So we put $40,000 down.
Yeah.
And we paid it off in 19 years.
Yeah.
So this year we'd be paying it off. Okay.
Which is a very fast amortization.
It's very quick. Yeah. So 19 years. I just did for the simplicity's sake.
Yeah.
So over that amount of time, we would have spent, in terms of interest, $108,000 in interest.
Just interest.
Just interest payments. So you also deduct that from the cost of, or from the purchase, or the sale price of the home, right? So if we take all those numbers out, so if we take out the $108,000 minus the $95,000 minus the renovations of $160,000, then we end up with an adjusted home value. If we sell it for $500,000, we would end up getting $136,276.34. Purchase price was $200,000.
Over 19 years.
Over 19 years, which actually gives us an adjusted CAGR of negative 2%.
Okay.
Not a great investment.
No.
$200,000. Right? So, but you would contend and say, well, okay, that's fair, but what would your rent have cost? Okay, that's a fair assessment.
Because you need to live somewhere.
So you need to rent.
You're always putting money.
Yeah,
down.
you need to live somewhere. So over that time, we figure right now in our area, you could rent a nice home like ours for about $2,000 a month.
That would be a nice. Like we're going into like the nicer properties.
And actually, a lot of them come furnished.
Yeah, a lot of them do.
Funny enough,
you can actually find if it was just me and you, we could find a very decent home for like $1,500 a month.
Yes.
But we had to account for our kids because we wanted to make it realistic. So
well, they need to live somewhere too.
Yes, they do. Unfortunately.
Unfortunately. So if you take $2,000 a month, which is obviously $24,000 a year, okay, you get over 19 years, and I kind of drew back and said, okay, rents are going up by about 3%.
Which is way high.
Which is actually high because there's rent controls and things like that.
In our
now, granted, at this level, there wouldn't be rent controls necessarily at 2,000. So
they would be out of the rent control rules.
Yeah, they'd be outside of the rent control rules.
Yeah.
But if you were renting within rent control rules, this could be even a little bit more conservative.
I would think though that out of the rent control, 3% would still be high.
Yeah.
Right, but in the rent control, 3% is. I actually looked back. And it's like within the rent controls, it's like 1% or less that landlords are allowed to raise their rents. Yeah.
So let's just be conservative and say that rents increase by 3% per year. So what I did is I extrapolated back and I said, well, what if, because I don't know exactly what rents were. So I said right now rents are $2,000. I extrapolated back and said, okay, we're going to discount that by 3%.
Smart.
Over time, right? And so back 19 years ago, we'll say this house would have been about $1,155 per month, to rent. And so that equates to a yearly rental of $13,000, $14,000, give or take, okay? And so if you extrapolate back and say, okay, you take back all the rent you would have paid about $351,510 in rent.
In 19 years.
In 19 years, you paid
a fairly equivalent home.
Yeah, you would have paid $350,000 in total rent. Okay. But you wouldn't have had the renovation costs, you would not have had the property tax bill, and you would not also have had the house insurance bill. So you gotta remember that. And interest payments. You wouldn't have had interest on a mortgage either, right? So you have to take all those things out in terms of getting comparables, right? So what if you had taken now that same money, that same principle, and you invested that in the S&P 500? Okay. What would you have gotten? Okay. So I took.
Do we want to know?
Okay, well,
do you and I want to know the answer?
I think you do. So if you had taken $40,000 of that starting capital and you put it in the S&P 500, and then you added, let's say the TFSAs were something at the time, and you had added $6,000 per year to that TFSA, okay?
Which is the max amount. Well, it's actually a little more than that, but on average, that's been above the max amount.
Which has been about the max amount. And you had done that reliably over 19 years, starting with $40,000, you'd end up with, and at 8% growth, which is give or take what the S&P 500 has done, you'd end up with a total of $384,542.
Okay.
In that account. Yes. Yeah. So what's the point here? So the point here is, on the one hand, with our home, we'd have a negative return when you take out everything. With the S&P 500, we'd have $384,000 sitting in the bank, right? But we wouldn't have the equity in our home of about $500,000, but we wouldn't have had all those costs. Right? So those are things you really got to factor in when you're making a decision for home ownership as an investment and all that. So I just thought it was an interesting exercise.
Yeah, and here's you said you wouldn't have the equity in your home, and that's how people think. Like, oh, I have $500,000 of equity, but we didn't have $500,000. We don't have $500,000.
We technically don't have $500,000 in equity because that equity cost us more than than $200,000.
So what I've realized in talking to people about this is that what people really struggle with is return on invested capital.
That's correct.
That's where they lose it. That's where they miss the mark when they're talking about how well their house is done, because they don't talk about that one little measure, return on invested capital.
Yes, that's right. So what if we project forward?
Okay.
Let's say go to the future.
Let's go to the
Let's
future.
go to the future, right?
Yeah.
Let's do a little tour to the future.
We'll be even older.
Yes, we'll be even older. I'm not saying how old.
Well, I'm sure if you go by, we've been living in this house for 19 years. We have 5 kids. You could probably figure it out.
Anyway, okay. So let's say we're starting over.
Okay.
So let's say we're 25 years old.
We're super savvy young investors.
Yes.
Right,
That's
which
correct.
we were not.
Which
We had
we were
no
not.
idea. We just
Yeah.
wanted. We were having kids. We had a family. We wanted a house.
So if things stay the way they have been,
Yeah.
there's a few assumptions we're making here. So we're going to do 25 years.
Okay.
Okay. So if we were to say this home, we like this home, we want to buy this home, okay, and at current interest rates, etc. Okay. Well, what would be the costs in income and whatnot? So we have a starting value of $500,000 for this house. If we assume that properties have grown or will grow over the next 25 years, as they have. In 25 years, this house should be worth $1,046,889.
Which sounds like a lot of money.
Which sounds like a lot of money, okay? But having said that, over that period of time, if you take the same assumptions, you'll have paid $187,765 in property tax, okay? And you'll have also probably paid $56,330 in home insurance, okay? And on that mortgage, now let's say you're to take 25 years to pay off the mortgage.
Which is way more common.
At current interest rates, you'll have paid $373,161.70 in interest payments on a $400,000 mortgage.
So the government's getting rich. The insurance companies are getting rich.
That's right.
And the banks are getting
rich. Right.
That makes sense. That tracks.
Yeah, that tracks. Yeah. Okay. So, but what happens then at the end of the day if you were to rent?
Yeah, okay.
Okay, so what happens if you're to rent? Your rent over that time, so we figure right now, I used the number of $2,000 per month.
So right now, someone's watching, they're 25 years old.
Yeah.
They're starting to think about
Yeah.
home ownership. That's right. This would be the difference if...
The total rent you'll have paid is $875,022 in rent over that period of time.
For a similar house.
For a similar
that we
house,
live in.
right. So what is the difference then? So what would happen then if you were to take that, so you say, okay, well, I have $1 million in equity in the house.
More than,
right? So just over $1 million, and you have paid almost $800,000.
Right. How am I any further ahead?
How are you any further ahead?
And also maybe I had to move a few times because my landlord said, "Oh, I'm using the house now," or whatever.
Right. So let's go back and say, okay, well, the total expenses on that house to over and above, the purchase price are $617,256. So your adjusted value of your house at the end of the 25 years is actually $429,632. So after you take out all those expenses, that's what your house is actually worth.
Right.
You say, well, I still paid, that much rent.
Right.
Right?
So
I paid $800. How am I ahead? But let's say you were savvy. And you took that $100,000 and you invested it in the S&P 500. And then you did the same thing.
And that's the down payment?
That's the down payment. So you took that $100,000 down payment.
Because you would have had to have that. If you wanted to buy the house, you would have had to have...
You put 20% down. Okay, let's say you put 20% down. And you also invested $6,000 per year. Because you would have had to be paying property tax and insurance. Exactly. So you're taking some of that out anyways. Yeah. So if you took that same down payment and you added $6,000 per year and it grew at 8% per year, you would end up with a total of $1,123,483. No capex. No capex. No property tax. So you do probably end up way ahead. Right. And here's the thing, people might be thinking well, I'm paying rent, so where am I getting this extra money? Yeah. And what we kind of said was that the mortgage and the rent kind of cross each other off. So you still have the extra money because you're not paying the property tax. Now, the other thing you don't have is your appliance breaking. Right. Your AC breaking. You're like, oh, hey, Mr.
Roof repair.
Landlord. You need new windows.
Right.
You don't need to do the flooring, right? So you don't have all these same renovation costs over time. And so at the end of the day, if you want a nicer house, you just move to a nicer house. And you can maybe find a deal. Exactly. And I'm going to circle back to the 1980s situation.
to our friends who bought that house, when you own something, the endowment effect is actually very strong.
That's right.
And so when you own your house, you are very attached to it. You've watched your children grow up there. You've poured literal blood, sweat, and tears into this home if
That's
you're
right.
keeping it up and whatnot. And here's another thing. You could argue, just a side note, you could argue, well, you don't have to put that much CapEx in.
Mm-hmm.
But if you don't do anything, you're also not going to be able to sell it for what we said.
That's right.
Right?
Yeah.
Because now it's like dilapidated.
Now it's a dilapidated house.
And maybe someone's looking at it and being like, well, I'm just going to like bulldoze that and start over. But
Yeah.
that's another situation. But
Yeah.
so back to the 1980s example I gave, you're so attached to your home if you own it that our friends actually could see the decline in the neighborhood, but they loved their house.
They loved their house and they couldn't bear to part with it.
No, they couldn't. And I remember talking to the wife, and she's like, we've just put so much work in, and I just love the yard. And,
Yeah.
and this was right around the time where the neighborhood was changing a little bit. And she was like, I just, it doesn't matter because I just love my house. And that's fine. Like, it doesn't matter. And that's great. And they love their neighbors too.
Yeah.
But if you're thinking that you're going to unlock the equity at some point, which our friends actually are thinking,
Yeah.
then the time to move was then.
Yes.
And if you're renting, you don't care.
Yeah.
Or if the neighborhood's changing and you're like, oh, the schools aren't as great anymore.
Yeah.
You're like, okay, I'm going to just rent in an area where the schools, if you have children, are better.
Yeah.
Or maybe the crime rate's gone up. Or where you're like, oh, I'm just going to move to a different area and rent there. But when you own it, it is very, very difficult. And it's just difficult from a practical standpoint. You have to get the house ready. You have
That's
to get
right.
a real estate agent.
Yeah.
You have to show your home. Like,
Yeah.
it's just, there's a lot of things about owning a house.
Well, and then selling the house, you pay real estate commissions.
Yeah.
Yeah. One interesting
Lawyer
thing,
fees.
lawyer fees, land transfer tax.
Transfer tax.
So all those things come into.
Which we didn't even talk about in the sale of the home.
No, we
by
didn't
the
even
way.
talk about that in the purchase
So
and
we're
sale.
probably like negative like 4%.
Oh
Kate.
gosh, yeah. Let's not go there.
Yeah.
One interesting thing in doing this exercise, though, is there may be a sweet spot in terms of home ownership. You could make a case for it. I don't think I mentioned this, but rent right now is actually on par, maybe even a little cheaper than making mortgage payments.
Especially if you stay within rent controls.
Right, especially if you stay within rent controls for an
Yeah.
equivalent house. But if rents continue to go up by 3%, your mortgage payments stay roughly the same. So in essence, what happens in purchasing a house, you freeze yourself in time, right?
Now, I will say we are at a disadvantage because you can only freeze yourself in time for 5 years in Canada.
That's right, and then you reset the
and so all
rates
of
and things
what we
like that.
said actually might not be the same in America because they get to freeze themselves in time for 30 years.
That's right, right. So at this point, one of the things I think, one of the hacks, I suppose, if I were to do it, what I would do is, if
Being
you're
older and wiser.
being older and wiser, is, again, go back to what I said before. You kind of freeze yourself in time. As the rent continues to go up, your mortgage payments stay roughly the same. And as you pay down your mortgage, obviously you're paying more towards the equity of the house. You're owning more of your home as time goes on. There's less going towards interest, more going towards back to you,
Yes.
right? Whereas rent, it's all going away. If I were to do it again, what I would probably do...
You're making your landlord wealthy.
You're making landlord
Maybe,
wealthy. Yeah, if
yeah.
you're making your landlord wealthy, basically. I think the hack is to purchase a home in an area you can easily afford and pay it off as soon as you can.
Yeah.
Right? Because after that, you have all that money, and if you were to keep reinvesting that money, right, you've, again, frozen yourself in time. You're not paying any payments to a landlord. So if you were to take all those interest payments now and put that into an S&P 500 index, you'd probably end up also with the equity of your house, but also with the compounding effect of the S&P 500.
Exactly.
Yeah.
And I think that's where a lot of people lose the home ownership game because a lot of people don't live within their means, especially when it comes to a house. And that's partly because the banks will lend you so much more than you can actually afford.
Yes.
You're a physician. So we'll be honest, you make a pretty
You make a good living.
You make
Yeah.
a pretty good living. And we live in our house in a working class area.
That's right.
And in order to save for retirement and raise our children, and right now we have no children in private school.
Right.
They all go to public school. Your colleagues' kids all go to private school. So you would say, well, you chose to have 5 kids. Yeah, but if we don't send them to private school, it kind of balances
kind of a
out
wash.
the 2 to 3, the
That's right.
2-kid family there.
That's right.
Kind of a wash. We find that we are not stretched here, but we're comfortable. But if we owned a house,
In an upper
a
class
larger
neighborhood,
house or the same house in an upper middle class area where, let's be honest, most physicians live, we would be stretched.
Yes.
We'd be very, very stretched. What you see out there is not what people make. So
That's
just
right.
keep that in mind.
Yep.
What you see physically is not actually real life.
Yes.
And then number two, if you can bring yourself to live in a neighborhood that's truly affordable,
Yep.
even if you think you should be living in a different neighborhood, don't succumb to that.
That's
and
right.
then you can kind of have the home ownership
Yes.
and not be so sad when your house isn't an investment.
That's right. Exactly. Yeah. And I think at the end of the day, it's sound financial advice to buy within your means.
Yeah, like no matter what.
No matter what.
And I just want to shout out to my parents because they did a really good job in raising me to know that.
Yeah.
You don't need to do that.
That's right.
Right.
So maybe to wrap up, how do we look at an investment?
Right.
Right?
What
is it? What is truly an investment? What is like the definition of an investment? Well, I look at an investment as basically a cash flowing asset. So strictly speaking, I can't cash flow my house. I mean, I guess you can if you rent out your basement or things like that.
Do that.
People are getting creative, right? Mm-hmm. But I mean, we don't because all our rooms are full.
No one wants to live with 5 kids anyways that aren't theirs.
That's right. Yeah. So an investment is a cash flowing asset. So at the end of the day, I don't view our house as a cash flowing asset, at least not at this point, right? So from that standpoint, it's not an investment and has not made a positive return either.
Yeah.
So from that standpoint, it's not been a good investment at all.
Right. And I would say my definition of an investment is a little bit different.
Mm-hmm.
So I would say an investment is just something that you buy now with the expectation that it's going to be worth more later. And the reason I don't say cash flow is, although I would with real estate, I wouldn't want to buy real estate with the assumption that my investment is only going to be land appreciation because you can't guarantee that. Yeah. But there's gold. Gold has no cash flow.
That is true.
So
yeah.
There's art. There's wine.
Yep.
There's a lot of things. I'm not saying I'm into that.
Collectibles.
My brother actually does collectibles and makes really good money off, and there's no cash flow off that.
We should have him on the show.
We definitely should.
Yeah.
He is just an expert in what he does. And so for me, an investment is just something that you buy with the intention of being worth more in the future. But
with a high probability.
With a high probability because you are very educated in that.
Yes, I agree with that. That's fair. Yeah. So,
but with real estate, it must cash flow in my mind.
Yes.
So is a house an investment? Maybe. Is your primary dwelling an investment?
That's the ultimate question.
Yeah, definitely not.
No. I mean, because at the end of the day, we also have other property investments that we've made that actually have worked out extremely well. So well over that current CAGR we quoted for our house. But it doesn't require really any capital expenditures.
Yeah, exactly.
And that's part of the difference.
Exactly.
Yeah.
So I think we can wrap it up there. That was a super fun, this has been a super fun podcast, YouTube video to prepare for.
Oh, yeah, no question. And maybe our viewers want to do this little exercise on their own house.
Right, and I'd love to know if they've actually found it different, that they're like, oh wow, I'm actually up 10% annualized.
Yeah, I mean, and make sure if you're doing this exercise, take out all the expenditures. Right. Be honest with yourself.
Exactly.
What have you spent on that asset and whatnot? Anyway.
Yeah, but I think if people knew the horrificness of the investment that a primary dwelling is, I think more people would live within their means.
Yeah.
But maybe not, because, I mean, why do you live outside of your means? Well, mostly because you want other people to see what you own.
I think that was a great discussion. I think we'll wrap up there. I don't know if we have much more to say on that topic right now. And leave comments. Let us know. Do the exercise yourself and let us know what you find.
Yeah.
And we'll see you next week.